day. Ira Epstein with your Ira Epstein Agriculture Update, and this is for Tuesday, and we're at the 19th of March, 2019. Remember, tomorrow we have the FOMC meeting. That'll dominate ideas of what's going on. The grains were a bit lower today as there's still disappointment that we're not getting an export deal done with China just yet. The word is that it's still being pushed back. Secretary of the Treasury Mnuchin and our head negotiator, Mr. Lighthizer, are both leaving in 6 days for China, and then when they return, the head negotiators of China are coming to the U.S. I personally think they're getting at the very end, and if you ever bought a home or anything, you know, right at the end is when all the deals, they don't come unraveled, but they get to be hard as you can finalize terms and so on. That's still what I think is going on. Dollar index down a little bit as the market and the financial markets watch the trade, but of course they're getting ready for the FOMC announcement tomorrow. When we look at a weekly area chart of soybeans, I wish I could say in any manner that I'm surprised, but I'm not. What the market's doing is fighting right now against the weekly 18-week moving average of closes. That's 903.25. You finish 904. When you come to the daily charts, you've put back in the pattern of lower highs and you've already had lower lows. So we'll define the trend is down until the market gets back over 911.5. The resistance, you got up to the 18-day average. You closed over at 1 day yesterday, right back under it. So what often happens, you get these breaks, and as I tell you, markets like to get back to what I call the line in the sand, the 18-day average of closes. Had it continued on yesterday, maybe we could have got to the 100-day. Right through there. Instead, the market reversed back down. Now, should you take out the 911.5, well, then I'd be making arguments that the market could be headed to that particular number. Right now, the bears, I think, defend their position at the 18-day average of closes. If the market were to break hard, one of the potential support zones could become the 88.75 number. And as you can see, momentum has gotten out of the oversold area. Now it's starting to flatten. So what I'm going to call this market is bearish. The trend is down as defined by the swing line. The bias is down and momentum is no longer pointing up. In the soy meal, you're void of trend. This rally since 330 has rallied all the way up to today's high of 312.30, and from there the market stalled a little bit. It was still an up day in the market. Should it continue, I'll look for these two numbers, the upper Bollinger Band. Remember what a Bollinger Band is. The black dashed lines represent an algorithm called a Bollinger Band. You go to Investopedia to learn about it if you want. But if you look at it, 95% of the time the market will trade within those bands. So the first assault of them is a resistance point or support points. That's the way that I teach it in my charting course. So if the market continues up between that Bollinger Band and the 100-day moving average, I'd look for resistance. You're already overbought. If the market pulls back, if it decides to break through today's lows, maybe it goes to the support of the 18-day average of closes. In the soy meal, you've done something different. Number one, you've got this big decline. You're no longer in sideways action. Number two, you have an embedded reading. Embedded means you convert a market from being oversold or overbought to locking in a trend. In this case, because both numbers that make up the slow stochastic, which are right here, are under 20 and have been that way for several days now, that means that as far as I'm concerned, rallies in the market will be sold by the pros until the red line gets back and closes over 20. Support, yesterday we said, hit the 100-day average of closes. Today it's extending a little. Next support, if it continues down, lower Bollinger Band, I'd assume. In the corn market, you reinstated what I'll call divergence in the market. I call it divergence because you still have this market moving up a little bit. Do you see that in terms of the momentum? Yet you've got lower highs, lower lows, and you're under the 18-day average of closes. So I'm going to call that divergence. Guess what would flip this market bullish? Take out 375.5 and I'd be arguing higher lows, higher highs, and then I'd be looking to see wherever the Bollinger Band is. It will fall tomorrow, so it'll be under that 100-day average by more. What do the bears do? They probably try to defend their positions at the 18-day average, but I doubt they'll be happy if you get over 375.5. In the wheat market, we now have 4 days in a row just fighting at that line in the sand. That 18-day average is the market is searching for what to do next. It had been in an uptrend with higher lows, higher highs, but the settlement under the 18-day average turns the bias down. Therefore, these things fight each other. Momentum, though, is still pointing to the upside. In the sugar market, yesterday, as we talked, you got to the 100-day average of closes, resistance. The market's still fighting with that. Momentum is still up, and the trend is still up as defined by higher lows, higher highs with upside bias. I see support at 1257. Take out 1226 and you wreck this particular chart package, if you want to call it, or the setup. Take out 1287 and you might catch these people, and wherever that upper Bollinger Band comes in, you might have a shot at that. In the coffee, the bears are still controlling the market, and it was a battle day today. You've got lower highs, lower lows. Now, you had an outside day down yesterday. That's Monday. You made an attempt to get to it today. You got to 97.80, didn't do very good, and then you came down. If the market breaks down, I'll be looking for the lower Bollinger Band. You'd have to get over 97.95 now to negate the downtrend, but that would not start just yet an uptrend. In the cocoa market, battleground is the 18-day average of closes. Now what you have is higher lows, higher highs, but a settlement under that number, and that's what you've been doing. So what I see in the market is the bias wants to stay down, the short-term swing line wants to point up, and momentum has gone flat, big nothing. In the cotton market, still bullish, but you're getting very close to a danger zone. The combination of the upper Bollinger Band and 100-day average should prove to be rather formidable for this market. You're overbought, uptrend, riding the band, but not really going very far in doing so. In the cattle market, 3 days in a row up and over the Bollinger Band. Now, the odds of staying over it is only 5% of the time. And when each day's in succession, I count each day as one of those percentage points. Can it get further than that? It certainly could. You'll see that in hogs, but it's a sign of strength, just the fact that the market didn't just hit it and turn away, that it's done in other parts to it. So I think the bulls have actually wrestled control of the market, as I'd like to call it. Let's talk about what we've got right here as I work with you on my trading kit. Talking about this, if you take a look at what's going on, it's a guide for futures trading. So let's assume you're new to the market, you want to learn a bit. I've had people that have come to us, and one of the people, they had actually bought my morning video subscription. They go, I want to learn more. This is how you learn. Think of this as a book with all this wrapped in, but it's obviously digital. And we connect to so many different parts to teach you the basics of what the futures markets and basically what charting is all about. If you want the history, we go through the history. Chart patterns, they're all in here. And folks, this is all free. Technical analysis, we try to explain that we think it's as much really art and science all wrapped into one. Gives you an idea of what some of the chapters might look like. Trading options on futures, very popular. By the way, copper options at the Merc hit an all-time high in the open interest in the market. Then we include some of our different videos, like we got pivot points, the Arun indicator. We put these all together so you can get to our website, learn about these different studies. So if you're somebody that wants to learn this, want to take advantage of what the exchanges put out with their quizzes, their numerous brochures, we put it together. And what we do at the CME Group is we point you right at the areas you need so you can learn. That's what this is all about. How do you get this? And remember, it's free. Simply give us a call, go to our website, and we'll put it together for you. If you go to the website, choose from this and any other offerings. I'm getting tongue-tied here, and we'll make sure we get them to you. Have a great day. I'm Ira Epstein.